So what if the clock on America's financial dominance is no longer counting upward, but counting down? For decades, Washington believed it controlled the world's purse strings. Countries were expected to buy U.S. debt, keep the dollar strong, and support the American economy, whether it benefited them or not. But suddenly, something unthinkable is happening. Across the African continent, nations are selling U.S. Treasury bonds faster than at any point in history.
People who work numbers, I am giving you free advice that those of you who are holding dollars, you surely might go into losses. You better do what you must do, because this market is going to be different in a couple of weeks.
They're ditching the dollar, turning toward new financial alliances, and doing the one thing America never thought possible, walking away from the system it built. And this isn't just an economic shift, it's a revolt, and it's already costing billions. Africa once served as a silent pillar, holding up the dollar-based global order. But now it's refusing to carry that burden anymore, from central banks redirecting reserves into gold and non-dollar currencies.
Namibia has made headlines after paying off a $750 million euro bond. And this marks the largest single-day debt repayment in its history. It's a strong move that positions the country as fiscally responsible and intentionally about how it manages its liabilities. But let's be clear. First off, Namibia is not entirely debt-free. We're just focusing on how well they have been able to manage their debt so far that they even had a record-breaking debt repayment system.
To governments signing trade agreements that cut America out completely, the continent is sending a message loud enough for Wall Street to hear. The era of U.S. financial control is ending. And here's what makes it even more explosive. The more Africa dumps U.S. debt, and the more expensive it becomes for America to borrow, interest rates rise, inflation spikes, the dollar weakens. Suddenly, the world's biggest economy looks vulnerable.
Nice idea, but it won't help. It'll just formalize the reality that poor countries can never repay their loans.
Senator, are you saying that you're opposed to debt relief for impoverished countries?
No, we should forgive the debts, but that's not going to help those countries very much.
Okay. What will?
Tax cuts.
If this trend continues, the consequences won't be felt in African capitals, they'll be felt in Washington. Because for the first time in 100 years, a global shift is happening without America's permission, and this time, it doesn't get to decide the rules. And the question now isn't if America will feel the pain, it's how soon.
All right, well, Africa is making serious strides to break with the US dollar and the West in general. Many of those moves are happening this week. More than 20 African nations are expected to attend the St. Petersburg International Economic Forum that starts today in Russia. We're going to talk more about that in a minute. But first, watch Kenyan President William Samoei Ruto speaking to Parliament this week, announcing that Kenya will start trading in local currencies within Africa and not the US dollar.
Global markets froze the moment the headline appeared. Africa had begun selling off large portions of its U.S. Treasury holdings. At first, analysts dismissed it as routine financial adjustments, but within hours, it became clear this was not a minor shift. It was a coordinated economic strategy. Central banks across the African continent were quietly and systematically dumping U.S. debt, and the move was too synchronized to be accidental. America had always assumed that Africa would remain a passive holder of its bonds, a silent financier of Washington's trillion-dollar deficits, but the continent had just signaled to the world that those days were over. For decades, the United States depended on foreign nations purchasing its debt to sustain government spending, military dominance, and global influence. U.S. Treasuries weren't just financial assets, they were the foundation of America's power. As long as the world kept buying U.S. debt, Washington could keep printing money without facing consequences. And for a long time, Africa played its part. Export-driven economies bought U.S. bonds as a safe store of value, and governments used the returns to stabilize their currencies, but something changed. Africa began asking a question no one had dared to ask before. Why should the continent continue financing the very power structure that benefited from African resources while giving so little in return? The United States had always treated Africa as a source of commodities, not as a financial equal. Yet Washington counted on Africa's wealth through minerals, oil, trade surpluses, and foreign reserves to support the U.S. bond market. The realization was uncomfortable. Africa wasn't just a supplier of raw materials. It was a silent shareholder in America's economy. The shift didn't happen overnight. It started slowly, with select African financial institutions quietly reducing their exposure to U.S. treasuries. Then the movement spread across central banks, regional development funds, and public investment authorities. Within weeks, the volume of African-held U.S. debt on the market surged. That was when Wall Street panicked. Selling that level of debt meant one thing: Africa no longer trusted the long-term value of the American dollar. The United States scrambled to understand the motivation, but Africa had already made its reasoning clear through actions rather than words. Instead of holding American debt, the continent began redirecting capital into domestic infrastructure, commodity-backed sovereign funds, regional trade financing, and technology development agreements with Asia and the Middle East. Africa was tired of watching its financial reserves build American power while African nations struggled with electricity shortages, infrastructure delays, and underfunded education systems. If the continent could invest in itself instead of Washington, why shouldn't it? American experts tried to frame the sell-off as reckless. Television networks called it financially irresponsible. Economists claimed Africa was attacking the global financial order, but behind closed doors, U.S. officials were terrified. If Africa was reducing reliance on the U.S. dollar, other regions might follow. If alternative trade systems emerged, the dollar's global reserve status, the foundation of American economic dominance, could begin to crack. The irony was painful. For years, Washington viewed Africa as economically dependent. Now it realized Africa was one of the pillars holding up the American monetary system, and that pillar was moving. Meanwhile, Africa wasn't acting out of rage or revenge. The strategy wasn't emotional, it was calculated. The continent had been studying what happened to other nations that relied too heavily on the dollar. It had analyzed how Washington used the global financial system not just for commerce but as a political tool. Africa saw how sanctions could freeze sovereign reserves overnight. It saw how countries that disagreed with Washington could be cut off from global trade. And it asked the most important question: why allow any nation to hold that kind of power over Africa's future? Dumping U.S. debt became more than an economic move. It became a declaration of independence. Countries across the continent began pricing some of their trade in local currencies rather than dollars. Others adopted cross-border settlement programs to reduce dependency on American financial institutions. Regional trade blocs accelerated their plans for a pan-African digital currency. Africa wasn't isolating itself, it was building alternatives. The United States understood the danger immediately. If Africa no longer needed the dollar for trade, the U.S. could no longer rely on Africa to absorb its excess debt. And if America had to raise interest rates to attract other buyers, its economy would slow and borrowing costs would spike. Washington had always believed it would be China that threatened American financial power. It never imagined the pressure would come from Africa quietly, without fanfare, without confrontation. In financial markets, the reaction was immediate. Bond yields climbed. Investors began speculating on the long-term stability of U.S. fiscal policy. Credit agencies whispered about potential rating concerns. These were small tremors, not earthquakes, but everyone knew what caused them. Africa had broken the silence. Rather than rushing to reassure America, Africa turned inward. Central banks met to discuss coordinated monetary strategies. Economic summits focused on sovereignty instead of aid. For the first time, Africa was talking about wealth differently, less about foreign investment, more about ownership. The continent wasn't rejecting globalization. It was rejecting dependency, and something else became impossible to ignore. Africa was no longer acting like a collection of individually vulnerable economies. It was behaving like a rising power bloc, one capable of influencing global markets not through oil embargoes or sanctions, but through simple financial discipline. America wasn't used to this kind of challenge. It could threaten military rivals, sanction strategic competitors, and outspend economic opponents, but it had no playbook. For a continent that simply stopped financing its debt, Washington couldn't force Africa to buy treasuries. It couldn't shame the continent back into compliance, and it couldn't ignore the consequences. The sell-off wasn't only about money. It was about respect, sovereignty, and self-determination. It was about a continent realizing it had the right to invest in its own future instead of sponsoring someone else's. And while America prepared to feel the pain, Africa prepared for something bigger, the chance to shape its financial destiny for the first time in modern history. The financial world continued watching Africa's sell-off with disbelief, but the most stunning part wasn't the size of the move, it was that Africa wasn't stopping. The continent had reached a point where simply reducing exposure to U.S. debt wasn't enough. Africa began making long-term structural changes to ensure the dollar would never again hold the power to dictate its economic trajectory. Regional central banks announced a plan that sent shockwaves through Washington. Africa would begin settling portions of international trade in African currencies backed by commodities. That single announcement meant the continent was no longer just selling U.S. treasuries, it was actively building a financial system in which the dollar would no longer be necessary. For decades, American influence thrived on the fact that global commerce flowed through the dollar. Now, Africa was positioning itself to step outside that system. Washington tried to interpret this shift as symbolic, insisting Africa's alternative trade system would be too unstable to gain traction. But when major energy, mining, and agricultural contracts across the continent began including non-dollar settlement options, analysts understood that this wasn't a symbolic gesture, it was a structural transition. The United States began sending diplomats disguised as trade envoys to African capitals. The message was always the same: selling U.S. debt was dangerous for Africa's financial future. But something had changed, and Africa refused to be intimidated. Instead of shrinking under warnings of market instability, central banks simply continued reinvesting reserve cash domestically, and with every reinvestment, Africa became slightly less dependent on the dollar. Europe watched with growing concern. It relied heavily on the petrodollar and the dollar-based financial system that gave the West ultimate leverage over global markets. If Africa proved that a continent could trade, develop, and industrialize without relying on the dollar, that example might inspire others. South America, Southeast Asia, and parts of the Middle East were already observing closely. Africa could be the first domino. Meanwhile, the United States began feeling the immediate consequences. Treasury auctions that once attracted eager demand suddenly faced weaker participation. To entice investors, Washington was forced to raise yields, a warning sign of growing fiscal pressure. For decades, America financed wars, infrastructure, stimulus programs, bank bailouts, and technological expansion through debt. But the engine that powered that cycle was foreign demand for U.S. treasuries. Africa stepping away didn't collapse the system, but it cracked it. Inside American financial circles, executives and policymakers debated whether Africa truly understood the damage it was causing. That question exposed the arrogance that had defined Washington's relationship with the continent. Africa wasn't blindly reacting, it was intentionally reshaping its financial destiny because the old system had failed to serve it. Africa watched trillions of dollars circulate around the world while millions of its own people lived without electricity, clean water, or affordable education. The economic structure was designed to keep Africa buying treasuries while exporting resources, a cycle that preserved global order at Africa's expense. Now the calculation was reversed. Africa wanted to build dams, power grids, ports, refineries, technology parks, industrial facilities, and research hubs. Every dollar invested in U.S. debt helped fund America's ambitions. Every dollar redirected back to Africa funded African progress. The continent had finally made a choice, and it chose itself. The American media attempted a different tactic: humiliation. Television personalities called Africa financially reckless, primitive, and unsophisticated. Newspapers published crude claims that Africa wasn't capable of managing its own reserves responsibly. But those insults backfired across the continent. African citizens watched the headlines, and instead of doubting their governments, they grew more confident that Africa was finally taking back control. A new generational mindset was forming, one that refused to measure Africa's progress by Western standards. Then Africa made another move Washington didn't expect. The continent began collaborating on a cross-border payment platform designed to allow businesses to trade seamlessly using local currencies without relying on Western financial institutions. Overnight, small and medium-sized African enterprises, the backbone of the economy, were empowered to participate in international trade without fighting currency manipulation or dollar shortages. This wasn't simply an economic shift, it was liberation. American policymakers realized Africa was playing a long game. A financial system that reduced reliance on foreign currencies would eventually reduce reliance on foreign lenders. Less foreign lending meant fewer opportunities for outside influence. By dumping U.S. debt and investing domestically, Africa was constructing a future in which it would no longer be forced into disadvantageous contracts or emergency loans simply to survive currency crises. Washington attempted one final strategy. Charm officials began speaking publicly about the importance of American-African partnership, suddenly praising Africa's innovation and leadership potential. But after decades of neglect, the praise sounded hollow. Africa remembered every time the continent asked for fair trade and was denied. Africa remembered every economic reform demanded by foreign institutions, every debt trap, every structural adjustment program that stunted growth rather than encouraged it. This time, the continent wasn't asking for respect, it was commanding it, and Washington could do nothing but watch as Africa continued transforming its financial architecture. Gold reserves increased, strategic mineral stockpiles expanded. Public banks were created for lending to African infrastructure rather than foreign corporations. Youth-driven investment programs emerged to keep profits circulating within the continent. Africa wasn't just selling U.S. debt, it was building wealth for the first time on its own terms. Markets began accepting what politics refused to acknowledge. Africa wasn't retreating from the world was evolving, and Africa was evolving with it. The continent didn't want to destroy the global economy, it simply refused to bankroll America's. The most telling moment came when an African financial summit declared that the continent had no intention of destabilizing global markets. Instead, the goal was clear, an economic structure where Africa would never again be powerless. If foreign currencies collapsed or if sanctions were used as a weapon, that statement wasn't a threat, it was a declaration of maturity. Still, America felt the pressure. Every month Africa sold a little more debt. Every month bond yields crept upward. Every month Washington's budget became harder to justify. It wasn't enough to break the economy, but it was enough to remind the world that U.S. dominance wasn't guaranteed. Africa wasn't acting like a continent seeking approval. It was acting like a financial power preparing to stand on its own. And for the first time in modern history, the United States was no longer in control of the narrative.